Scalping is akin to those thrilling action movies that keep you at the edge of your seat. It's a fast-paced, exhilarating, and mentally stimulating trading approach. Scalp trading, also known as scalping, is a widely used strategy characterized by short durations between trade entry and exit. Typically, these trades are held for just a few seconds to a few minutes at most. The primary objective of Forex scalpers is to capture small increments of pips repeatedly during the most active trading periods of the day. The strategy's name reflects its approach. Traders aim to scalp numerous small profits from a large number of trades throughout the day. What makes scalping such an appealing choice for traders? In even relatively calm markets, smaller price movements occur more frequently than larger ones. This abundance of small price fluctuations provides ample opportunities for scalpers to capitalize on. Scalpers can execute multiple trades, ranging from a few to several hundred, within a single day, aiming for small profits with each trade. All positions are closed by the end of the trading day, ensuring no overnight exposure and allowing for a fresh start each day. Given the need for constant monitoring of charts, scalping is best suited for individuals who can dedicate several hours of uninterrupted focus to their trading activities. Successful scalping requires sharp concentration and rapid decision-making abilities. It is a trading style that demands speed and agility, which may not be suitable for everyone. Scalping is not about consistently making large wins, but rather about accumulating numerous small profits over time to generate an overall positive return. It appeals to those who prefer a gradual and steady approach to profitability. Scalping the Forex market. The essence of scalping lies in the belief that numerous small wins can accumulate into substantial profits. This approach involves seizing opportunities presented by rapid fluctuations in the bid-ask spread. Scalping concentrates on maximizing gains through larger position sizes, aiming for smaller profits within extremely short holding periods ranging from a few seconds to minutes. The strategy assumes that price movements will quickly complete their initial phase, making use of market volatility to capitalize on swift changes. Market volatility serves as a valuable ally for scalpers. In highly volatile conditions, scalpers can swiftly switch between opening long and short positions, closing them promptly to exploit various market movements. The primary objective of scalping is to enter a position at the ask or bid price and promptly exit the trade a few points higher or lower, securing a profit. A scalper aims to swiftly bridge the spread between bid and ask prices. For instance, when going long on EUR/USD with a bid-ask spread of 2 pips, the trade starts with an unrealized loss of 2 pips. Remember, buying occurs at the ask price, but selling, necessary to exit the trade, happens at the bid price. A scalper desires that initial to PIP loss to swiftly transform into a gain. This requires the bid price to rise sufficiently above the ask price at the trade's entry point. Signs you might be a Forex scalper. You enjoy the thrill and fast-paced nature of trading. You are willing to dedicate several hours to closely monitor charts. Impatience is not an issue for you, and you prefer quick trades over longer ones. You have the ability to rapidly adapt and change your trading bias or direction. Signs you might not be a Forex scalper. Fast-moving environments tend to stress you out. You are unable to allocate several hours of uninterrupted focus to monitor charts. You prefer making fewer trades with potentially higher profit gains. You prefer taking your time to analyze the broader market landscape before making trading decisions.